And let's take a look at our first walkthrough for cost accounting. This practice set here will cover both chapters 1 and 2. Again, these two chapters are somewhat a review, an overview of the types of things that we went through in managerial accounting, and wanted to make sure we take a look at these and just remind ourselves of some of the basic terminology and some of the basic formulas that we learned there that we will be using throughout the cost accounting course as well. So let's get started here. Okay, this first question here is actually, I think I got my stuff turned around here. Okay, first question here is actually just definitional by nature. It's asking you to determine by looking at the cost which stage you will find that particular item in the value chain. Remembering again that when we talk about this value chain, we're talking about things that are being where value is being added in our system here. And so we need to understand where those different points are, especially when it comes to cost cutting assignments, or when you're going through and analyzing things to see where you can cut cost. You want to know where they are in the stage, because certain stages lend themselves more to cost cutting than others. So when we talk about a programmer's cost for a new operating system, this is something that we would find in research and development. With regards to the cost to ship computers to the customers, that is most definitely a distribution item. We're distributing the products to the customers. The call center cost for support calls would be obviously a customer service item there. So hopefully you get the hint at what they're looking for here. I don't necessarily want to finish the three of these here. I'll leave that up to you. Let's move to question 2. This particular question has a set of data here that we will use for question 2 as well as question 3. Question 2 is asking you for one set of questions to be answered. Question 3 just has you answering different questions regarding it. But with this one here, we're dealing with State University. And right now they offer several degrees, including a BBA or a Bachelor's of Business Administration. The school actually believes in using cost accounting information, the new dean does, to make decisions, and is considering closing down the BBA program because the analysis shows a loss. And we see this is the analysis that we're looking at here. Tuition increases are not possible, and the dean has asked for our advice here. So if the BBA degree program is dropped, here's some information we need to be mindful of as we start working this analysis. If the program is dropped, the school administration costs are not expected to change, but direct cost of the program, such as the operating cost, building maintenance, and classroom cost, would be saved. There will be no other changes in the operations or cost of other programs. These are the pieces of information that you have to keep in mind, because what we're going to do is go down here and look at all the information they've given us and determine what will change based upon the information that they've given us here. So using the worksheet that they have given us here, they want us to determine which revenues and costs are probably differential for the decision to drop the BBA program. If you recall, when we talk about differential cost, we're talking about, or differential revenues or cost, we're talking about things that would be different. What's going to change if we follow through with this particular decision? So if we decide to drop this program, obviously all of the revenues are going away. So that entire $6 million is gone. So we're going to drop in the $6 million here. And this is a differential cost. The advertising for the BBA program. Well, they have it listed here at $225, and if we're not running the program, we will not be advertising it. So that one is differential. The faculty salaries here are listed at $3,060,000. We're not running the program. We don't need faculty. The degree operating cost for our part-time staff here, $390,000. This is specific to this degree, and this is how they worded it for us. That would be a differential cost that would go away if we eliminate the program. The building maintenance cost, which is $555,000. They specifically tell us that this is a direct cost of the program, and so we're going to eliminate that as well. The classroom cost. This is listed at $1,275,000. Again, we're looking for information up here. They indicate that that is one of those direct costs, which means that it directly relates to the program and it will be eliminated if we eliminate the program. Differential here. And then the allocated school administration cost. This is $645,000, but they let us know here, where did that line go? The school administration costs are not expected to change, which is not unusual, at least in its entirely anyway. Sometimes you can salvage some of that cost, but a lot of times when it's allocated, it's something that's happening at a higher level and it still has to be paid for, even if you eliminate a particular program, or if we're not dealing with the school, a product line or service line. So that is something that will not be eliminated, so it is not differential. What we end up with here then is total cost of $5,505,000. So as far as our bottom line goes, the net differential here is going to be a gain, still a gain, because we have revenues that are more than these costs. So we are looking at $495,000. That's the end of requirement A here. Let's look at requirement B. They want to know what will be the net effect on the subs contribution or profit, excuse me, and subs being the State University Business School. If the BBA program is dropped, what's going to happen if we drop this BBA program? And looking at the analysis that we just completed, right now, this program is contributing $495,000 towards the overall net income of the company. And so if we eliminate the program, we are actually eliminating this money. So that would be to decrease it by $495,000. This again highlights the fact that we can't just look at a departmental income statement type situation to make a decision on dropping a certain product line, or in this case, a program. One of the keys is this number here, that 645,000, because this is allocated and it still has to be paid even if we drop the program. This is what's making the difference here. So let's move on to question 3. Again, excuse me, same information, but what they want us to do this time is to determine what the contribution to the combined BBA program would be if we consider the estimates that they have given us here. So actually what I did personally in working this problem is just, and you can do it on a separate sheet of paper, I like to jot each one of these items down individually. I have revenues here where they're saying revenues are going to be 2 times somewhere in here. Okay, the school estimates that the combined BBA revenue would be twice what the current revenue is, and that's just for the BBA program. You have to read these very carefully. Right now, the school's revenue is $600,000, and and it's saying that the BBA's revenue would be twice that amount. So we have to go down to this section here, and we are looking at $12 million. And then we go into the cost. And this is what we're going to do here. Look at all this individual information and bump these numbers, this information, bump these numbers, and put the results in the boxes that we see here. As far as advertising is concerned, it tells us that advertising would be 3 times what the current amount is. So let's see, they word that a little bit funny. So let's take a look at it. Revenues. Evening program will be new. Advertising expenses for the evening session would be 3 times their current level. So the current level is 225,000. And they're saying that the advertising for just the BBA program would be 3 times what that amount is. So they're looking at taking this amount plus 3 times that amount. That's how they're intending for this to be worded in this case. So that would actually give us $900,000. That's the 225 plus 675,000 additional for the new program. The faculty salaries, they tell us, would be 2 times or twice the current amount. Faculty salaries would double. It's at $3,060,000 now, so it would be bumped to $6,120,000. The degree operating cost, excuse me, would increase by 50%. So when we look at that information, degree operating cost, right now it is at $390,000. So we want to multiply that times 1.5. That gives us a 50% increase. And that gives us $585,000. The building maintenance. They tell us that that won't change, so we're going to drop in that number. Remember that this is not a differential. We actually want to know what the net gain from the BBA programs would be. This is not the differential piece. So the classroom cost, $1,275,000. They also tell us that that would be unchanged. And then the classroom rental. They indicate here that we would have to have additional space at a cost of $300,000. So we drop that number in here. And then the differential school administration cost. They tell us here that it would increase by $30,000. And so we end up with $9,765,000 in total cost. We compare that to $12 million in revenues. The difference between those two numbers gives us $2,235,000 in net gain from the BBA programs. And that is the end of question 3. Question 4, again, is a matching, just dealing with the responsibilities. You should find this information in the textbook, and as you go through the reading, even some of the Smart Book questions probably refer to these as well. Each Smart Book can have different questions in it. So by now you probably know this though, but you won't have the same questions necessarily as other students in the class. But just as an example here, what are the responsibilities of the CFO? The CFO is the one who is going to sign off on the financial statements. When it comes to the treasurer is the one who determines where to invest cash balances. And this is just information that you would find straight out of the book here. I'm going to jump down to the internal auditor. Primarily because I used to actually work this position on the internal audit staff for a company before, actually for one of the automakers. And the the auditors are there to make sure, the internal auditors anyway, are there to make sure that the company's rules are being followed. And in my particular position as an internal auditor, I actually flew around the country to different dealerships on what we called compliance audits. Compliance audits, which is basically what it's saying here, to ensure that the rules are followed. And so we would audit the service departments of these different dealerships. And whenever you go in for a warranty repair, and if they have to remove a part to replace it in your vehicle, let's say even if you're dealing with a recall or something, when they take the old part from your vehicle, they have to keep it because technically that part belongs to that automaker, and they tag it and they have to put it in storage. When the auditors come in, if that part, so we would pull different invoices for things that have been billed back to the manufacturer, and if that part is not in their storage area, we could bill them back for it. So this is just one example of what an internal auditor would do in making sure that those in the company are following the rules. The other two, I'll leave it up to you. There's information in your textbook. This is just, again, somewhat definitional. Number 5 here is very basic to some of the things that we would have covered in a managerial accounting class. And you're just being asked for some of the specific calculations that would have been in the first few chapters of that course. So the variable cost per unit, the variable manufacturing cost per unit, the full absorption cost, all of those things we're going to pull the numbers for. Variable cost per unit, obviously we're going to go up here and pull everything variable. So we want the variable manufacturing, actually direct materials is the first one here. We're looking at $21. Direct materials, direct labor, and the variable portion of the manufacturing overhead in addition to any variable marketing and admin cost. We want to add all those things together. So 21 for direct materials. Where's my labor? Labor's here at $24. We have $12 worth of variable manufacturing overhead. And then we also want to include the $5 for the variable marketing and administration. So the 21 plus 12 plus 24 plus 5 gives us $62 per unit in variable cost. Well, what about the variable manufacturing cost per unit? We're basically saying all of those things, but I don't want to include the marketing and administrative cost. So if we back that $5 out, we're at $57 because these are not manufacturing cost. Remember again that when we talk about manufacturing, anything that happens in the factory, in the plant, those are some of the buzzwords that you might see, indicates that it is a manufacturing cost. Also indicates if you see the term product cost, that's what we're talking about. Determine the full absorption cost per unit. Now this is going to be different because with absorption costing, we only use the manufacturing cost, and this would mean that we also we need all of the manufacturing costs, so even the fixed piece of it. So when we look at the full absorption cost, I said that wrong. We want to use the entire cost that would end up going into cost of goods sold. So we're talking about our direct materials, direct labor, and all of our overhead here. So in this case, we're looking at 21 plus 24 plus the 12 here. And then we want to take a look at the other manufacturing piece here, just to clarify it. We have $135,000 total. So how do we handle that? Well, that's the total spread out over all the units produced and sold. So we just take that number, divide it by 30,000. And, excuse me, if we do the math there, if I find a calculator, I thought I had the number written down somewhere. I do. It's $4.50 per unit. 135 divided by 30 gives us another $4.50. So this full absorption cost is strictly our manufacturing cost, but it is all of the manufacturing cost. All of that cost that if we were doing this in the absorption costing income statement format would be included in the cost of goods sold. So again, direct materials, direct labor, our variable manufacturing overhead, plus the fixed manufacturing overhead, which we have to calculate, and that's an additional $450. We add those numbers together and we end up with $61.50. The full cost per unit. So what are we doing here? We have the full absorption cost per unit. So what we want to do with that full absorption cost is add to it the fixed marketing, which again is given to us as a total amount. We take that, divide it by the 30,000, and that gives us $3.90 per unit. And then we're going to add the $5 for the variable marketing piece. So the full cost per unit is basically going to be all of those costs, but we have to determine the per units where any of the fixed pieces are concerned. So the 6150 includes our direct materials, direct labor, and factory overhead. And we just want to add the marketing administrative cost to that. That adds another $8.90. So we have $70.40 here. So what is our profit margin per unit? They give us a price, a sale price of $79 per unit. So we want to take the $79 and subtract from that the $70.40, which is the full cost per unit. So if we are doing, looking at our profit, we have considered not only the manufacturing cost, but the marketing and admin cost, and that gives us our profit. And that works out to $8.60. Again, that is the $79 sale price minus our full cost per unit of $70.40. The gross margin per unit. Remember that gross margin is our sale price minus cost of goods sold. And remember that I told you that the $61.50 is the cost of goods sold. So $79 minus $61.50 gives us $17.50. And then finally, our contribution margin per unit. We are still going to take our sales price, and if you recall what contribution margin is, sales price minus the variable cost gives us our contribution margin. And so we have our variable cost per unit here at $62. So 79 minus 62 gives us $17 per unit in contribution margin. Moving on to number 6. And this one has 2 parts. The first thing they're asking us to do is to take a look at this information for Alpine Coffee Roasters for the month of November and prepare a gross margin income statement first, and then requirement B, ask for a contribution margin income statement. Just to remind you, the gross margin income statement is the one that is required by GAAP. It is the one that it's it's also the absorption costing income statement, where we're going to take a look at our sales and minus our manufacturing cost or the cost of goods sold. So sales minus cost of goods sold equals gross profit or gross margin, and then we subtract our operating cost to arrive at our operating profit. So that's the first thing that we're going to do here. We're looking at sales revenue, and they give us the units produced and the sales per unit. So we're going to take the 36,000 units times $6.40, and that gives us $230,400. And then we start into the manufacturing cost, and they break it down by variable and fixed manufacturing. They don't lump them together. So we're looking at variable manufacturing cost, and they tell us that we have, let me get the lines right here and blow this up a little bit so I can see it better. We have $3 in material cost, $40 in labor, and 40 cents in labor, and 10 cents per unit in variable manufacturing cost. And again, excuse me, this is just the variable piece. So that's $3.50 times the 36,000 units. That gives us $126,000 in variable manufacturing costs. Our fixed manufacturing overhead cost, the fixed piece was based on the 36,000 units, And they broke that down to $1.25 per unit. So all we're doing is taking the 125 and multiplying it back times the 36,000 units. And that gives us $45,000. So once we take our sales minus our cost of goods sold, both of these added together are equal to cost of goods sold. That gives us our gross margin. And it is positive here, the $230,400 minus these two numbers here. We come up with a gross margin of $59,400. The next item is to subtract, and they break the marketing down into variable and fixed components as well, primarily because the next thing we're doing is the contribution margin, and we need it broken down in that way. But the variable marketing is 30 cents per unit. Multiply that times 36,000 units. And we come up with 10,800. And then the fixed marketing and admin is 50 cents times the 36,000 units, as we see here. And that gives us 18,000. This gives us an operating profit. If we take here the gross margin minus these two numbers, gives us a gross profit of $30,600. And that's our gross margin format for the income statement. Again, this is also called the absorption costing income statement format. Let's move to requirement B, where we're looking at the contribution margin income statement. Again, this one is in the format of sales minus all of your variable cost equals contribution margin minus all of your fixed cost will equal the operating income. So, and looking at same information, and some of the numbers we won't have to calculate again because we've already done that. But we always, again, start with sales. That will not change because of the format here. So we have the $230,400. Next item will be the variable manufacturing cost. We already calculated that in the previous problem at $126,000. So when you're working this, you might want to take a picture of A so you don't have to calculate again. And then we have our variable marketing and administrative cost, which we again already calculated at $10,800. Those are it for the variable pieces. So the next item is our contribution margin. And we take the sales minus those two numbers. We come up with $93,600. We go into our fixed manufacturing overhead cost. Excuse me. And that is $45,000. Again, the numbers are, we already calculated in A. And then we have the fixed marketing and admin. And that is $18,000. This gives us an operating profit of the same exact amount, $30,600. But again, in looking at these two different ways of presenting the income statements, the requirement A, the gross margin method, is the method that is required by GAAP because it follows with the matching principle. The numbers that represent cost of goods sold are indicated here, and that is because you know by the matching principle that the cost related to or the expenses related to a sale have to be reported in that same period. However, when we are dealing with internal decision making, what we are really doing in many cases by pulling all of the fixed cost here is taking and only including relevant cost in the top section here. A lot of times the costs that you find here, especially for fixed manufacturing, are sunk cost, and we don't want to consider those in our decision making. So it's just easier to have it separated already in the contribution margin income statement format. And that's it for question 6. We move on to the final question. And this is the largest of the questions here. This one has us preparing a cost of goods manufactured and sold statement, and then an income statement as well. Let's see. Okay, so when we look at the cost of goods manufactured statement, we want to always begin with work in process, because the first thing we have to do is actually calculate our materials piece. If you recall the work in process statement, we had like this little 5-step calculation that we would perform for determining the amount of materials used. We had another similar 5-step calculation to determine the cost of goods manufactured, and another one to determine the cost of goods sold. They always started with the beginning inventory balance. We would add whatever was appropriate for that particular calculation, come up with a subtotal, and then subtract the ending inventory to come up with what we were looking for there. So when we talk about trying to calculate the, let me get my, I guess I better put it in here now to just get it out of the way. But when you look at this, they did not give you the total amount of materials that were used. So we have to calculate that, which means we have to embed that particular, what they're actually doing, I should say. We don't have to, and some companies don't do it. They will do this material calculation separate, but they are actually embedding it in the cost of goods manufactured statement in this case. So the beginning work in process for January, we're going to, that was 403,250, just a number that's given here at the top, somewhere here. Okay, because the cost of goods manufactured is the goods manufactured are the goods that you actually complete in the production process for that period. So the only inventory that we could complete are the units that were actually in process already. So because that's what this statement is, we're going to start with the beginning work in process, and we will end up, I'm trying to get these lines right. I can't line it up yet. Total overhead. Well, we'll get to it when we get there. It's too many blank lines for me to try to figure that one out ahead of time. But we're going to subtract the ending inventory before we actually get to the cost of goods manufactured. And, oh, it's actually right here. Ending work in process. Okay. And that ending work in process number is given to us at the top here as well, 396,700. So we're going to drop that number in. Okay, so what happens between the beginning and ending work in process number? We're looking at the beginning work in process plus my direct materials, direct labor, and overhead. That will give me my total manufacturing cost. And then I'm going to, again, back out the ending work in process, and that lets me know what the cost of goods manufactured is. And then I have to do another inventory calculation adjustment that we'll get to in a minute there. So how do I determine how much in materials was used? I have a 5-step calculation that deals with the raw materials. I'm going to take the beginning direct materials inventory from January 1st. That number here is, this is the type of problem that I actually like to print a copy out first, and then I check these numbers off as I use them, so that it minimizes how much looking I have to do later. But the beginning direct materials inventory for January 1st, we're looking at $1,069,200. $1,069,200. Okay, and to that, I am going to add the direct material purchases. So that's what I'm looking for next. Direct materials purchased during the year, $8,956,000. This gives me direct materials available for use. That's my subtotal in that 5-step calculation. That's $10,025,200. Just adding these two together. And then I'm going to subtract the ending in direct materials inventory balance. In managerial accounting, you might be used to seeing this as raw materials instead of direct materials, but so that number, if we look back up top, the ending is 1,235,000. Okay, and this will give us the amount of materials that were used. So if we take the direct materials available minus the ending balance, it says that we used $8,790,200 in materials. To that, we need to add our direct labor. Direct labor is, nope, that's indirect. 4,692,500. And so we have direct materials, direct labor. Now we have to list the manufacturing overhead. This means we need to go up and grab all of the items that we find here that are manufacturing overhead items. And the best way to do it is just to go down the list. Admin salaries, excuse me, those are not in the plant. That's not a manufacturing cost. Skip it. Depreciation on the admin building, not related to manufacturing. Depreciation on the manufacturing plant. This 1,750,000 needs to go down here. Depreciation on the manufacturing plant, 1,750,000. Next item we are looking at is the indirect. Let's see. We did all of these already. So I'm looking for indirect manufacturing labor, which is 542,000. What's next? Insurance on the manufacturing plant. And it needs to be anything related to the plant. Then it's got to go here. So $215,400. And that's for insurance. Next item, legal fees. It doesn't say that it's related to the plant, so no. Maintenance on the plant, $215,400. I think I grabbed the wrong number for insurance. Let's see what that is. I did, 53,200. And then we have what's next? Manufacturing plant utilities, $784,100. And that was $784,100. What's next? Marketing cost, no. Other manufacturing plant cost, $638,80. And do we have anything else? Sales revenue, no. Taxes on the manufacturing plant, $215,600. These are property taxes, but they're on the plant. So if it happens in the plant, it's a manufacturing cost. $215,600. I think that was it, because the other two are inventory. So we're done with listing those manufacturing over. Notice that that's probably most of the costs that we find in this big pile of information here. So we end up with 4,191,180 in overhead. We add those numbers together there, and we're looking at direct materials, direct labor, and overhead, giving us manufacturing costs that have been added during this current period that amount to $17,673,880. Looking for a gadget here. Okay, and so the total cost of work in process during the year, if we take the 403,250 that we had as a beginning balance, add it to that, 18,077,130. That's the total cost of everything that was in our manufacturing plant for the year. Okay, what's next here? The cost of goods manufactured for the year. I mentioned that this was a five-step process. So the beginning balance plus the additional cost that was added minus our ending work in process gives us a cost of goods manufactured for the year. And that total is $17,680,430. Oh, come on here. Okay. So that's the cost of goods manufactured for the year. But we're also asked to prepare the cost of goods sold. They said manufactured and sold, so we have to continue with this. Cost of goods manufactured. The Remember again that we have the beginning balance plus the additional cost for the year gives us a subtotal. Well, we had to add we had to add together through all these calculations what is to be added for the cost of goods sold piece, and that is the cost of goods manufactured for this year. So then we put the beginning balance, add the beginning balance to that for January 1st. That number is beginning, and we want the beginning finished goods in this case. 1,642,000. This gives us cost of goods available for sale. Add these two together. Typically, if we're writing the formula out again, we would see the beginning balance plus cost of goods manufactured equals cost of goods available for sale. So these two are just switched, but because they're added together, it doesn't matter what order you're going to put them in. This gives us 19,322,430. And then finally, we subtract the ending finished goods, and I can see the light at the end of the tunnel. $1,369,500. And this is from the top here. This gives us a cost of goods sold of $17,952,930. Okay, and this is just taking what's available minus the ending finished goods, and that gives us the cost of goods sold. And that is the end of that cost of goods manufactured and cost of goods sold statement. Let's check my work here. Answer is not complete. Okay, why is it saying that? Because we did not do the income statement, and we knew that. Okay. But we wanted to make sure that this piece of it was right before we move to the income statement, because we need this cost of goods sold number to prepare our income statement. So income statement says sales, and the sales revenue has to be in here somewhere. 22,654,920. I've been working too many problems all day here. Okay, the next thing we have is our cost of goods sold. Cost of goods sold is going to come from this bottom line, 17,952,930. 17,952,930. This gives us gross margin, and do the math here. 22,654, 920 minus 17,952,930. And that gives us a gross margin of 4,701,990. Okay. Then we move into our, after we calculate the gross margin, we move into operating expenses. So we want to go up here and see what operating expenses we find. We have administrative salaries. We have depreciation on the admin building, distribution cost, legal fees, marketing cost. That's it. So we're going to go list those things. Let's go grab them again. I should have, oh, I do have a picture of it here. We have our admin salaries, and they total $2,625,000. We have the depreciation on the admin building. That is $1,142,000. What else did we say there? We have distribution cost. At $657,000. I'm just trying to avoid the scrolling, so I'm looking at a picture of this. Not indirect labor. How about legal fees? Legal fees were $496,300. Marketing cost, $749,250. And I believe that is it. So we have 4,701,990 for gross margin, and we have total operating cost that exceed 5 million. So this looks like it's going to be a loss unless I dropped in a number incorrectly. So let's see what this number is, and I'm actually going to use a check my work to make sure we put all the numbers in right before I go through the trouble of adding it together. Okay, and it is going to be an operating loss. You have to use these check my works wisely. Actually, I think I gave you guys unlimited check my works anyway, so. But I don't want to go through the trouble of adding them up if it's going to be the wrong number, and I can know ahead of time anyway. So 4,701,990 minus 5,669,550. I end up with a net loss of $967,560. Let's make sure I did that math right. It says we did, and it also says our answer is complete and correct, and that is the end of the practice set for chapters 1 and 2. If you have any questions as you work through this or as you work through the homework, which will be similar, be sure to let me know.